They lied to you. For 40 years, you were told to put money in the box, close the lid, and wait. You were told that when you retired, your tax rate would be lower. But they didn't tell you about the silent partner. The government has been waiting in the shadows. If you withdraw money the way your bank tells you to, you could lose 40% of your life savings. Today, I show you how to opt out of their game. You did everything right. You worked hard. Maybe you skipped a few vacations or drove an older car just to put a little extra into that retirement account. You trusted the plan. Now, you are ready to enjoy it. But the rules of the game change the moment you stop working. The bank won't tell you this, and your HR department didn't tell you this. But you need to know it now. The first trap is something financial experts call the tax torpedo. It sounds dangerous because it is. It sinks the retirement plans of millions of seniors every year. It starts with a simple misunderstanding about your Social Security. Most of us believe that money is ours. We paid into the system from every paycheck since our first job, so we think it should be tax-free. But that is not how the system works. The government views your Social Security as income, and they are watching your other money closely. The moment you touch your 401k or your IRA, you wake up the silent partner. He sees you have money, and he decides it is time to tax your Social Security check too. Let me explain this simply without any complex math. Just picture two buckets. Imagine you have a blue bucket for your 401k and a red bucket for your Social Security. You want to take some money out of the blue 401k bucket to pay for a new roof or a trip to see the grandkids, so you tip the bucket and pour the water. But here is the problem. As soon as you pour from the 401k, the Social Security bucket springs a leak. The government rules say that if your income goes up because of a withdrawal, you must pay taxes on your benefits. You didn't just pay tax on the 401k money. You triggered a tax on the money you thought was safe. It is like going to a diner and buying a cup of coffee. But because you bought that coffee, the waiter suddenly charges you double for the donut you already ate. It doesn't seem fair. It feels like a penalty for saving money. But this is the law. They call it provisional income, but I call it the double dip. This tax torpedo can act like an invisible tax of 50% or more. You pull out $1 to spend, but you only keep 50 cents of value after the silent partner takes his share from both buckets. This is why standard advice fails. If you just withdraw money blindly, you are walking right into their trap. Taxes are painful. They eat away at your freedom. But there is actually something worse than taxes. At least with taxes, we know the rules. We can plan for them. But there is another danger lurking in your retirement account. It is unpredictable. It is violent. And it doesn't care about your plans. What happens if you need to pay bills, but the market crashes the same week you retire? It isn't just bad luck. It is a mathematical disaster. If you take money out when the market is down, you might never recover. Wall Street has a fancy name for this, but I call it the casino trap. Let me show you how to avoid it. Imagine you retire on a Friday. You are happy and ready to relax. But on Monday, the stock market drops 20%. If you were still working, you would just wait for it to go back up. But you are not working. You need money for food, bills, and gas. You have to sell some of your investments to get cash. This is where the trap snaps shut. This is what I call a fire sale. Imagine your house is worth $500,000, but suddenly the market drops. Would you sell your house for $200,000 just to buy groceries? Of course not. But that is exactly what happens when you withdraw cash from your 401k during a crash. You are locking in your losses forever. Wall Street calls this sequence of returns risk. It sounds boring, but it is deadly. It basically means that if you have bad luck in your first few years of retirement, you could run out of money 10 years too early. It is not about how much you saved. It is about when you start spending. It is the difference between a comfortable life and a nervous one. Think of your life savings like a herd of cows. You want to live off the milk. The milk is the interest and the growth your money makes. But if the market is down and you withdraw money, you are not just drinking the milk. You are killing the cows to eat steaks. If you kill the cows, there is no milk tomorrow. Soon, you are left with an empty field. You might be thinking, okay, I see the danger. I will just leave the money alone when the market is down. I will wait for it to recover. That sounds like a smart plan, but the government is way ahead of you. They have a rule that forbids you from waiting. They will not let you sit on your cash forever. Welcome to the Required Minimum Distribution, or RMD. This is the government tapping you on the shoulder when you reach your 70s. They are saying, we are tired of waiting for our cut. Pay us now. They force you to take money out of your account, whether you need it or not. They do not care if the market is crashing. They do not care if selling now kills your cows. They force the withdrawal because they want the tax revenue. You lose control over your own money. You are forced to create taxable income that you did not ask for. And this forced income triggers another nasty surprise. This is the hidden trap that shocks most seniors. It involves your health care. When the government forces you to take that money out, your income on paper goes up. The government sees this higher income and decides to double or even triple your Medicare premiums. It is a penalty hidden in plain sight. Suddenly, your health insurance costs much more. You are not sicker. You did not go to the doctor more often. You simply followed the rules and took your own money out of your own account. Because of that, the system punishes you by making your health care more expensive. It is a system designed to leak money from every direction. It feels like the deck is stacked against you. And it is. Every rule seems designed to take a piece of your nest egg before you can enjoy it. But there is a way to shuffle the deck in your favor. There is a way to opt out of these traps completely. Let's fire the silent partner. We stop withdrawing blindly. We stop hoping for the best. Instead, we use a strategy. We take control back from the government. The goal is simple. We want to pay taxes when they are cheap, not when we are desperate. We want to choose when we pay, rather than letting the IRS force us to pay. The first step is to lock the silent partner out of your house. We do this by moving your money from the tax-deferred box, like your traditional 401k, into a tax-free box, like a Roth account. We don't do it all at once, because that would cost too much. We do it slowly, year by year, filling up the low tax brackets. Think of yourself like a farmer. You have a bag of seeds. Those seeds are your money today. You can pay tax on the small bag of seeds right now, or you can wait and pay tax on the entire harvest later. Which would you choose? The government wants you to pay on the harvest, but the smart move is to pay tax on the seed. Once you move that money and pay the tax on the seed, the crop grows tax-free forever. When you pull the money out later, the silent partner gets nothing. Zero. You keep every penny. And the best part? There are no forced withdrawals on this money. You decide when to use it. To protect yourself from market crashes, we use the 3-bucket strategy. Imagine 3 jars on your kitchen table. The first jar is for now. This holds cash and safe money to pay your bills for the next 2 years. If the stock market crashes, you don't care. You spend from the now jar. The second jar is for later. This money stays invested to grow and refill your first jar. The third jar is never taxed. This is your Roth money. It grows without the government touching it. By sorting your money this way, you never have to sell your house during a fire sale. You are safe. This is how you win. You pay taxes on the seed, not the harvest. You keep safe cash for rainy days, so you never have to kill your cows. You simply move your money strategically to lock the IRS out of your future growth. You are not just saving money, you are saving your peace of mind. The 401k system is tricky, but it is beatable if you know the rules. They don't print on the brochure. You have worked too hard to let hidden taxes and bad timing ruin your golden years. You have the power to fire the silent partner. You just needed the right map. But before you go, you need to know one more secret. There is one specific asset class that the IRS cannot touch. And no, it is not gold or silver. In the next video, I will reveal the invisible vault that protects your wealth better than a bank. You won't want to miss that. Please remember, I am a financial educator, not your personal CPA. Every situation is different. This video is for educational purposes only. Always consult a professional before making major moves with your nest egg. Stay safe and see you in the next video.